All right, so let me start by doing a little recap, of the things that we've covered. All right, we talked about order blocks. Um, there will be another. We'll hit on that again. I'll talk about a different style of order block. Um, we talked about imbalances. That's when price explodes in a direction, either up or down, and it leaves an imbalance because you have only one market participant, whether they're the bears or the bulls, right? Then we spent 3 weeks talking about Wyckoff, how to identify the patterns. You guys know that you can Google the Wyckoff schematics. Um, that way you can see it playing out on your particular time frame. It'll help you with direction and maybe where you can potentially enter the market for a trade. Today, I want to talk about liquidity. Liquidity, if you think about it, is that's the gas for the moves in the market. Okay. Liquidity is what keeps the candles moving. Okay. The candles move towards liquidity. After it liquidates folks, it will move to the next area where it can liquidate more people. So the objective, in the long run, is to be able to spot the liquidity without becoming the liquidity. So I'm going to take a look at a chart. Maybe we won't take a look at the chart. Hang on 1 minute. Okay, CAD CHF. It's always good to kind of zoom out. I know what we like to do is open up the chart, kind of get right to what we are looking for, like the current price action. But if you zoom out of a chart, it doesn't matter what time frame you're on, you can kind of look for your supply and demand zones, right? For those of you who don't know what a supply and demand zone is, it's what you guys used to refer to as support and resistance, right? These zones provide information and opportunity, right? So this is why I encourage you guys to frame your trades, because when you frame your trades, it helps you identify the zones that you can trade off of. Okay. You're going to get a reaction when price comes to these levels. So if we look at current price comes up, we expect a reaction in this area because the zone has been identified. Price comes right to it, hits it, pushes down. Okay. Whenever you're trading these zones, you're kind of anticipating what you're going to get, and in most cases, you're expecting price to come to these zones and give you a reaction. So you kind of have your alert set, and you're hopping in the trade as soon as it hits your zone, because it's going to push in the opposite direction. So where is the liquidity on this chart? Let's talk about it. Anytime you have highs and lows, there is liquidity. So you just take you a line and you draw it. Liquidity above this line, right? Market comes up, snatches that liquidity, goes in the opposite direction. When you have these lows here, liquidity. Market comes down, snatches this liquidity. Goes up, snatches that liquidity. Comes down, gives you equal lows. Spikes up, takes out the lows, snatches the liquidity. All these lows were ran. So if you understand, or if you can spot the liquidity, you can train yourself to not become the liquidity, right? When you see positions stacking up, all right, you see these equal highs. If you can spot this at the beginning, of the week, then it'll help you understand, where the market could potentially move that week, or if you do it from the weekly, maybe that month, or if you do it from the daily, maybe the next few days. This will help you understand where you may want to enter the market. You want to enter for shorts, or you want to watch and see if the candle wicks, then you can hop in for a short, and you can go down to the bottom. That's where the market is going to, once it takes out the liquidity at the top, it's pushing in the opposite direction. Those are the moves that you want to find, because those are the moves that's going to guarantee you the long run, right? That's going to give you a healthy pip count down to the bottom side of that liquidity once it takes the top side, or vice versa. So there's a video that we'll watch, basically that'll kind of help you shape your mindset, towards institutional trading. And also, it will also help you, maybe identify some trading opportunities that are going to happen for you in the future. Once you start to see this stuff play out, it becomes a lot easier to develop a trading plan / trading strategy that's, I guess, devised around valid concepts, right? And the concepts are, the market is going to take out liquidity. So your rules and your plan can help you to avoid becoming that liquidity. So maybe you're only entering once the highs have been taken out. You're only entering shorts once the highs have been taken out. Or maybe you're only entering longs once the lows have been taken out on that time frame, right? So I trade the daily. This is a great opportunity right here. Once this daily range was taken out right here, great opportunity to go short. This is a great opportunity to go long once the shorts were taken out, right? So he took out the shorts, took out the longs. You know that they were going to come back and push the market down. Later on, in the smart money introduction to smart money concept, we'll listen to some traders who have been doing this a while, and you'll kind of see this stuff happening, from the things that they tell you. But once they took out the low and then they came and took out the high, you knew the market was going to push down significantly, right? That's how it works. So we'll watch the video, and then we'll come back and we'll talk about maybe how to identify some of this stuff or how to set up your trades, as you see some of this stuff taking place.
Most of the information you can find online is usually all about retail trading. If you look for institutional trading, you can't find much about it. Smart money trading is perhaps one of the best kept secrets in the world of trading. Once you discover institutional trading and learn how smart money plays their orders, you can implement these concepts to your own style of trading and see much better results. So let me show you several smart money concepts you must follow in order to finally become a profitable trader. There is no indicator, robot, or mechanical trading system that will make you money if you don't understand how and why price moves. In reality, if you rely your decisions on indicators, you're not really trading the market. You're just really plugging numbers into a few mathematical formulas. Indicators have absolutely no flexibility. They are just an equation that is used over and over again, regardless of market conditions. Stochastics, MACD, and a load of other indicators are presenting you with lagging information. They may look pretty on your chart and can help you to some degree to view a market, but they don't really help you predict where the price is going in the future. Indicators show you what has happened in the past, but they won't tell you what price is going to do in the future. Indicators used to be a powerful tool, but those days have passed. Stochastic was created in the 1950s, MACD in the 60s, and the RSI in the 70s. Do you see the connection? These lagging indicators were in use before modern computer systems took over the trading world. The problem is that even though computers were invented and people got access to technology, they never moved away from the old way of viewing the market. Trading without indicators is just like eliminating the middleman. Instead of letting indicators to tell you what the market is doing, you can see it for yourself. So the first step, try trading for a few weeks without indicators. Any chart is a sequence of zones where there is supply and demand equilibrium with supply and demand imbalances in between. If you are used to trade classic support and resistance levels, I advise you to forget about them for a second and focus on supply and demand zones, especially the zones where the price is moving away from with a lot of momentum. Whenever that happens, it's a sign that the balance of supply and demand has shifted in a very substantial way. Supply and demand zones are the origins of these price moves. A supply zone is an area at which a lot of sudden selling has occurred. This resulted in an imbalance between supply and demand, where supply greatly exceeded demand, pushing the price down. A demand zone is an area at which a lot of sudden buying has occurred. This resulted in an imbalance between supply and demand, where demand greatly exceeded supply, pushing the price up. I consider supply and demand as a leading indicator. While traditionally, support and resistance levels are only called as such after at least 2 tests, this is not the case with supply and demand. You only need a supply or demand zone to be created in order to plan a potential trade. So use the following steps to identify supply and demand. First, you find the momentum drive. Here, you're looking for a large price move. Long, successive candles in one direction work the best. Just open any chart, and it shouldn't be too difficult to find those. Both the momentum, how fast the price is moving, and the absolute distance, how far did price move before it stopped going in that direction, are relevant here. Of course, the best price moves show both momentum and a large absolute distance. After you have found the momentum drive, you should have defined your base. With the base, I mean the price area just before the price exploded in one direction. Often, you will see a small consolidation before this happens, and that's the consolidation that you're looking for. Especially, try to find the last bearish price action before a bullish price move, and the last bullish price action before a bearish price move. This is the area that is responsible for the resulting move. The base of a supply or demand zone is where the orders were placed that were responsible for moving the market in such a strong way. Volume is not difficult to understand once the basic principles of supply and demand are understood. This requires you to relate the volume with the price action. To say that the market will go up when there is more buying, demand than selling, and go down where there is more selling, supply than buying, may seem like an obvious statement. To understand what the volume is saying to you, you have to ask yourself, what has the price done on a particular volume? Think about it. If you compare today's volume with the volume during the previous 30 bars, it's easy to see if today's volume is higher or lower, but you took volume in isolation, and that means very little. Compare this volume information with the price spread, and you'll then know how bullish or bearish the market really is. Volume spread analysis is the type of analysis based on volumes and the spread of the candlesticks. It tries to find out the differences between supply and demand. The price spread is the difference between the highest and the lowest trading points reached during the time frame you are looking at, which may be weekly, daily, hourly, or whatever other time frame you choose. Some traders consider the actual body of the candle as the spread. You decide which method you want to apply. There are a lot of different interpretations of the VSA, which makes it difficult to understand it for a beginner trader. At first, you need to get familiarized with the most commonly used models of the VSA, so make sure you watch this video about volume spread analysis after you finish this one. In order to understand why supply and demand zones can work as the basis of a trading strategy, you need to understand how buyers and sellers behave around the zones. A lot of this comes down to finding liquidity. Liquidity describes how easily an asset can be bought or sold. Where there is a lot of liquidity, we say that your orders can easily be absorbed by the markets. It means that there are many traders willing to take the other side of your order. When there is little liquidity, it might be harder to get your orders filled, because there might not be enough traders to take the other side of your trade at the price you want. You might get filled at a worse price than expected. This is why some institutional traders use special techniques to get a good price for their order. Whenever institutional traders need to open a position, they do so with much larger size than the average retail trader. In fact, their positions are usually so big that if they were to simply enter at once, they would move the market considerably. So whenever institutional traders need to enter a large buy order, they will do so part by part, waiting for the price to come down before pushing the next slice on the market. This creates patterns on the chart, and the more you trade supply and demand, the more you will see the underlying dynamics of certain patterns that happen before supply and demand momentum drives. Another aspect is that institutional traders understand where liquidity is accumulating. Let's take this chart as an example. The institutional trader is looking for enough liquidity to get a fill on his big order. He wants to go long, but he needs to find traders who want to sell their position to him. Below this swing low, there will be lots of that liquidity. First, you'll have the stop losses of buy orders, which will sell on the market once they're hit. Additionally, there will also be traders who will go short, again, adding liquidity to the market. This is why you will often see a spike in the opposite direction at the origin of a strong price move. The liquidity spike is the pattern that gets created when large market participants need liquidity and move the market in order to get it. Retail traders get trapped, their stops get hit, and they will often talk about stop hunting, while in fact, this is nothing more than normal market behavior. So now you know how smart money operates and why they operate in a certain way. It's time to find opportunities. The best way to do this is to mark out certain levels, such as daily highs and lows, weekly highs and lows, obvious swing points, and boundaries of ranges. By marking out these important areas of liquidity, and then analyzing what happens once the liquidity at these areas gets triggered, you can get a better understanding of how smart money operates. You can then make up rules to develop an entire strategy around this concept. Of course, the next step is to backtest the rules and generate data to confirm a trading edge. One of the best ways to identify absorption of liquidity by a bigger player is to look at candle closes and the violence of moves. Is the high of a range being taken out, but price quickly and aggressively falls back into the range? Then the buy side liquidity above the range has been triggered and absorbed by the smart money to fill a short order. Waiting for confirmation is often very important. You want to see clear triggering of liquidity and then the absorption of that liquidity in order to join them. Smart money enter the markets to fill orders, generate liquidity, and to hedge their longer-term investments or trades. This is not how us retail traders trade. This is the difference between retail trading and institutional trading. We try to profit from small directional moves. So how to start trading like banks? Start with being as prepared as possible and treat your trading like you are running a business. Banks don't just let the RSI tell them when to enter. Every position they take is well calculated. They know exactly what they need to buy, when they need to buy it, and how they need to buy it. They know the costs involved. That's how you should approach trading as well. You can start trading like the smart money by following these principles: knowing your edge, having multiple plans, and reviewing and learning. These are the most important points to consider when you want to become a profitable trader, not by learning a concept that banks supposedly use, but by approaching trading the same as banks and professionals do. It's absolutely vital to know your edge. Without an edge, you will probably fail. How do you get one? By learning concepts that work in a market. Then you start with building rules around these concepts. The next step is testing it on years of data, followed by demo trading and live trading. In order to be able to execute your edge effectively, and in order to improve, you need multiple plans. You need a pre-market plan, a plan for executing, and a post-market plan. A pre-market plan is all about how you find the setups with your edge. How do you need to analyze the markets and when? Make it as clear as possible. This minimizes the mistakes you are going to make. The most important thing is that you have a clear, written down plan. After your session, it's time to analyze. You will always make losing trades. Most traders simply go to the next trade. If you also proceed this way, this means you wasted your money. But if you actually take the time to learn from your losers, that's not wasted money, but simply a down payment for a valuable lesson. If you found value and learned something new, leave us a like. This way we'll know if you'd like to see more videos like this one. And check out our Academy program if you want to further level up your trading. Until next time.
All right. So, I always try
If you're looking for the most effective strategies to trade price action, I want your full attention.
I always try to find a video where the guy has an accent to make sure you're paying attention. No, seriously, there's a lot of good information that the video pulled out. So I want to talk about let's go back to my little chart here. Okay. If you zoom this on the weekly, I'm going to move this out of the way so it won't be right there. with this AU setup, where is the liquidity, right? You have your relative equal lows right here, right? Everybody see that? Market comes up. First, it gives you your relative equal highs. Then it wicks your highs. Comes down to your lows, takes the lows out. See that? So if you're paying attention, this move was in November. It bottoms out at the November 1st. Basically, it took a month for it to come down, right? Then January, double bottoms. March, the market comes up to the top. And here we are in May, where they take out the lows here. What's going to happen next, right? So we show you the break of structure to the downside. So I'm expecting the market to push down further. But since we took out the lows, we have to push up first, right? Y'all see that? So now we have to engineer liquidity. And, as you learned, in some of the other classes, when you get a break of structure, the market's going to push back up to that source of the break before it pushes the direction it's trying to go. So don't expect a straightforward push up here and then for it to fall. It's going to engineer some liquidity before it pushes back to the downside. So whenever I'm analyzing the market, I like looking at the higher time frames. The higher time frames keep me honest, right? It helps me paint a picture and get a better understanding of what's going on the lower time frames. And it helps me keep my head straight, and not jump in and try to chase a trade, right? So understanding what's transpired, in these markets, this is why I was looking for longs, right? I mean, if you think about it, the news just helps with everything that's happening, right? So with the AU trade, basically we got bad news as far as our financial reports on Wall Street. Inflation is out of control. So the dollar started falling, right? And it started falling right after it took out the lows. After it went so high that it took out the lows here. Then all of a sudden the dollar started falling. So how long is it going to fall, right? Well, for me, I look at the next area of liquidity, which is here, right? So maybe it will give us equal highs right here and then push down, right? Then at some point, it's going to come back up, take out these equal highs before it pushes back down. And this is all, if you notice, I'm anticipating these moves. I'm not reacting to these moves. This is the picture that I see from what the market is doing or has done this far. Now, if you understand, smart money concepts, and Alicia and Brianna touch on this, whenever they teach their classes, when you get that break of structure, you go back to the order block that created that break of structure, right? And this is the order block that's responsible for this break of structure. So why wouldn't the market come back, give us equal highs, relative equal highs? It doesn't necessarily have to come the same height, right? It can come close to being the same height and generate the equal highs. It can push past and take these highs out. Then it's going to shoot for these lows down here. Does everybody understand that? Are you guys tracking?
Yes.
Okay, so this is how I analyze my charts and how I pick my trade setups, right? So you might not be at that level yet. Maybe you are simply saying, I got a bullish order block. I'm looking for a trade, which is fine, right? That's where everybody starts, right? Everybody starts, hey man, bullish order block, I need to pick my trade. So it's not hard to go from, hey, bullish order block, I need to pick my trade, to, hey, bullish order block, I didn't get tapped in. The market is going to come back and revisit this area. Now, when it comes back, bam, you're in the trade, right? And you're taking it to this high right here. It's not hard to go from step one to step two, right? It just takes a little patience, right? It takes patience, and I guess, stacking the things that you learn on individual sessions, maybe videos that you watch, outside of these sessions. It just takes a little patience and understanding for you to stack these concepts together, these classes together, to see the bigger picture. And once you start seeing the bigger picture, you'll understand how to utilize your time frames to your advantage, right? Just like we looked at this weekly, and we see what's going on with the liquidity. Where is the liquidity? Where is the market moving? So now you can drop down to your daily, and you can look for longs, right? Or you can drop down to the 4 hour, understanding that the market is going to move to the upside, but on your 4 hour, you're going to have engineered liquidity that's going to push the market to the upside. Now you have a break of structure down here on the 4 hour. So what's going to happen? The market should trade back down to the order block that broke this structure. And that's where you'll find your entry to go long, right? You see how you can get your picture, get the big picture from the weekly, drop down to the daily. You see the break of structure down here for the market to push to the upside. I mean, the market is going to push to the downside, but because of the break of structure, it needs to go back up to find the order block that pushes down. So when you drop down to the 4 hour, you get another break of structure to the upside. So, the market needs to come down to this order block that causes the break. Now you get your source or your area that you're looking for the up move. You can do this. It just keep dropping down and keep dropping down. And you can narrow this thing down like to a 3 pip or 1 pip or 2 pip area that you're interested in. And it'll help you pick your trades out. And the overall direction that you're looking for is this up move, right? And once the market starts pushing up, you're going to take out this engineered liquidity, right? So if you look you can stretch this line out. I mean, if you're a retail trader, it's in a channel. It's in a channel, right? I don't know how they, anyway, the trend lines are set up, and retail traders are just trading this like in a fog. I remember when I was there, and I used to get excited about this kind of stuff. But now that I understand the bigger picture, this line is setting up for you to be liquidated. Everybody who's going short, every time the price hits this line, eventually is going to get liquidated when this price explodes through here. And, it's unfortunate, but that's just how it is, right? Like, as you gain a bigger understanding, a better understanding of how to look for liquidity, this will help you to stay out of the fray by utilizing your larger time frames, right? Drop a 1 in the chat if you understand what you just saw. So only one person. Okay, drop a 2 if you don't understand. So we know you don't understand. Essence, you didn't drop nothing. Oh my God. All right. Let's go back over it for the people in the back. Essence, pay attention, please. Were you here for the video, Essence, or did you come in late?
I was here for the video.
Okay. So you understand that the market is going to move to the liquidity, right? I need a response.
Oh, yes.
And you understand that the liquidity rests above these relative equal highs, right?
Yes.
And you see that wick that takes the liquidity out.
Yeah.
So once they take this liquidity out, the market comes down, there's more liquidity down here at these equal lows, right?
Yeah.
We go below that. You see that?
Yeah.
Now the market is coming up. Where is it going next? Well, if you notice, we got a break of structure past these lows, right?
Mm-hmm.
It's a break of structure. That lets you know that the market is going to go lower. But it's not just going to keep going lower, right? It's got to push back up to the order block that caused this break of structure, right? Does that
Okay.
make sense? Now, we need to drop down to a different time frame. Here's your order block that caused the break of structure. So I expect price to push back up to this order block before it pushes further down.
Okay.
So if I expect price to push back up, maybe 300 pips, I want to collect some of that money, right?
Yes.
Okay, so now I got to find a trade opportunity for it to push up. What you've learned in the past, there's order blocks here, like this order block will get you in the trade, right?
Mm-hmm.
And you get wicked in. That's cool. But to advance your knowledge, there is a better way for you to find an entry if you keep dropping down. So here you are on the 4 hour. On the 4 hour, you'll notice that you have a break of structure, right?
Yes.
See how price broke structure going up?
Mm-hmm.
It's what you expected. We all expect price to go up, but we get the structure break. So what order block caused this structure break? This order block right here, right?
Okay.
So what you want to do is you want to find where price needs to come to this order block in order to take you a trade to the top side. So all you have to do is keep dropping down, you know, and if you keep dropping down from the 4 hour, maybe you go down to the hour. There's your order block right here. You see it?
Okay. Yeah. Why wouldn't it be the one above that?
Why wouldn't it be here? Well, you could have taken it. You see, you could have taken a trade here. You wouldn't have been taking it to equal highs. There's nothing wrong with that.
Okay.
But bigger picture, if you're looking to take the trade from here all the way up, you want to find probably some imbalance that hasn't been mitigated. And there's your imbalance that hasn't been mitigated. You see that little box within the box?
Mm-hmm.
So that's on a lower time frame. So what I expect to see is the market to come down, tap in, and then go up, right? Now, you
Okay.
don't have to drop that far down. I'm kind of taking this in steps, so I didn't take you that far down. I took you to the 4 hour, right? I mean, if you know me, so you know that I never talk about the 4 hour chart really, daily, weekly, right? This is baby steps. We're walking you down. And yet, yes, Rhonda, you can do this on any pair. But I'm walking you down baby steps to help you kind of paint your own picture when you start looking at your charts and doing your analysis, right? That's why I started at the weekly, so we can identify the liquidity, right? We can see what's been going on. We have a bias for what direction the market is moving. Now I'm showing you kind of what's happening to, confirm your bias, right?
Yes.
So this is all based, this is an analysis, right? Like at the end of the day, the market doesn't have to respect, my entry here. Maybe it doesn't go all the way down to this area of liquidity. Maybe it just keeps pushing up. The point is, if you use this order block, you're in the trade, right? You see how it wicked you in the trade? I'm just trying to help you be able to drop down and refine your entries and basically give you a better understanding of what you're looking at when you see these candles. In the past, you just see an order block. You see how now that you can drop down and you see this break of structure. Remember how I used to talk about, the order block is a break of structure. It's the green candle breaking the structure of the red candle. But now that you're ready, we can drop down and we can show you this is that order block. It's that break of structure.
Oh, okay. So it's that green candle still, right?
Yes. It's
Okay.
see where it is? That's all that is. Now, you can see where this red candle dipped back in, right? That's this move.
Okay.
So I'm just expecting it to dip further and then go up.
Okay.
But this is how you can drop down in your time frames to actually see what's going on in these candles, right? It's
Yes.
the picture, it just becomes more clear when you start dropping down.
Hey, Watu, I mean, another way for her to think about it, and I guess anybody for that matter, is like you see that green candle on this daily chart.
Which
And
one?
yeah, that one that your fingers on. And I'm not necessarily talking to you, I'm talking to the group, because I'm sure you already noticed. So you got that green candle on this daily chart, and when you drop down to the 4 hour, drop down to the 4 hour. If you count 6 candles, because there's 6 4-hour blocks in 24 hours, then the 6 candles.
You start right here. 1, 2, 3, 4, 5, 6.
That's all in that one green candle on the daily. So it just kind of gives you an idea of what's going on inside of that one daily candle.
Did he confuse you, Essence?
No.
Okay. I was gonna say he was a crappy teacher.
No, he's fine.
But so now that we've kind of broken it down, do you understand better what I was getting at? You had a 2 in the chat before, but now do you understand?
Yeah, I understand that part, I believe. I think, okay, I guess, yeah, I have the understanding, because you say that it's gonna go up to the order block, but it's still gonna sell because it's still going lower.
Well, the reason I say it's going to sell is because it broke structure.
Yeah.
And here's the difference, guys. If you look at this weekly candle, when it came up top, it didn't break the structure. It wicked. It gave you a wick, right? Which means it didn't break this level. So that tells you that it's not going higher. The wick, right? Wicks say it's not going, but when you get a candle and it breaks structure, that tells you, hey, it's going lower.
Okay, so the body has to break the structure, not the wick.
Yes.
Okay.
Is everybody tracking? Alicia, you quiet. Ain't heard a peep. It's super important that you grasp what we're talking about. These are the very, very basics, right? We haven't talked about change of character moves. We haven't talked about shifts or any of that. But if you couple everything together, what you know about order blocks, imbalances, how you've been taught, to enter the trade, all of this stuff makes sense, right? All of these moves kind of help you out. All righty. So if everybody understands, that's as far as we're going to take this today, right? So I think we have a good base for kind of understanding how to analyze the charts for our next move, and how to read what the charts are telling us as far as liquidity and where the market is moving next, right? This is a great chart example of a story that's being painted for us. Every chart has one. So when you start looking at the charts, I encourage you to use, at least the weekly, for your high, but use your higher time frames, and it will give you a bias, a directional bias that the market is going to move towards, right? And this will allow you some room for error, because when you start dropping down, chances are you're not going to have every move correct, right? Like, I can't tell you with 100% certainty that the market is going to come here, right? I have a pretty good idea, but there's also, because I listen to so many people, and I have, a pretty good understanding of what I'm looking for. A lot of people, our ICT is going to wait for this up move. I don't know how far up it's going to go, but let's just say it goes to the top of this candle, right? He'll wait for the up move or wherever it's going up, because it's not just going to go straight up, and he'll wait for it to pull back. And let's say it goes here first before it pulls back. He's not going to enter this trade until it comes back to the 78.6, right? So this initial move, he won't get involved with. Once the market pulls back, then he'll get involved, to go to the next level. So you guys will be able to kind of pick and choose how you're going to operate, in the market. But in order for you to do that, you're going to have to kind of understand how to drop down and utilize your time frames to see what it is that you're trying to see, right? Whether it's, your kill zone times, whether it's the market taking out the previous session high or previous session low, all that stuff is going on, right? Like, this is a daily chart. So you figure 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. This is a 10-day sequence of events. Took 10 days for price to drop, retrace. And then another probably 10 days, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, for it to drop and push up. So you're going to have to decide how you're going to go about entering and exiting your trades, right? That trade management is going to come from you. Whether you trade this daily, a lot of you guys, I know you're 4-hour traders, whether you trade the 1 hour, right? You're still going to need to get your information from the higher time frames, right? This is your safe zone. This is, if you frame this market, this is your protected area. So you can operate within this area, but understanding that price is going to be pushing up through this area, and then it'll be pushing back down. So you can operate on those lower time frames, but if you make a mistake, you have to understand that you might be caught up in one of these retracements. Like, if the market is pushing up on a daily, and you jump in for a long on the 4-hour, maybe the daily is retracing, and you jump in for a long on the 4-hour, and you didn't pay attention that the daily was retracing, and that's how you get liquidated on those lower time frames. So going forward, when you start analyzing your charts, make sure you're looking from the top, from at least the weekly, going down through your time periods so you can get an understanding of what's going on. And that's the real reason why I like using, I like to have one signal on the weekly, like let's say a bearish order block on the weekly and a bullish order block on the daily. Those are ideal trade setups for me at the start of the week, because I can hop in for the buy, and whenever it decides to start selling that week, then I'm already in the trade for a buy, and that's a natural hedge, and I can just flip the switch to the sell and sell it for the rest of the week. Whether that happens on Tuesday, whether it happens on Thursday, or maybe it never even starts selling that week. Maybe it just goes into the order block and buys up, and then the next week it starts selling. Either way, it's a win-win situation. You guys understand? You tracking?
Tracking.
All righty. So I'm going to go ahead and stop this recording. And next week we'll pick up on these smart money concepts, and we'll kind of elaborate and go a little bit further. We're going to talk a little bit next week about some, information sources that that I was able to get from ICT. As far as we'll talk about the interest rate website and that good stuff. If you guys have time, you might want to start looking at some of these series, like the Market Maker series, the Went series from ICT. I know he's a long-winded guy, but the information is really priceless. Monk, we're on 10 a.m. on Sunday, but we go 11 a.m. on Saturday with everybody else. 10 a.m. Sunday class is just intro to smart money concepts.